What is up, YouTube? We are back again here on Life with Dan with another stock market video for you guys. If you watched my stock market video last week, what I did was reveal what stocks I currently hold in my Robinhood portfolio as of today. So what I'd like to do today is give you guys some news updates on just two of the stocks in that portfolio, specifically two of the most beaten down speculative stocks that I hold. These two companies are stocks that are still down at or around 50% for the year, so they are arguably one of the more risky stocks that I hold. We're going to go into some news updates on these two companies, and I'm going to touch base with you guys on how I'm still feeling about these companies, whether I'm still a buyer, whether I'm looking to hold, or whether I'm hoping to sell. So if it's your first time tuning into this channel, thanks so much for checking it out. Hope you enjoy the video, and we'll get right into it right after the intro. So thanks again for tuning into this video, ladies and gentlemen. If you get any sort of value out of this video, I just ask that you hit the like and subscribe button so that you can keep up with all the content that I'll be putting out. To get right into it, the two companies that we'll be going into today are going to be Boeing and Simon Property Group. Now, both of these companies are positions that I started no more than 6 months ago, so these are both new companies to me. And like I mentioned at the beginning of the video, both have been beaten down very hard due to COVID in past months. With Boeing having a lot of its business in the commercial airplane, air travel space, and Simon Properties having most of its business in the retail real estate space, it's obvious that both of these companies have taken major hits to the bottom line just due to the fact that people aren't available or aren't willing to use the things that they provide. People aren't flying planes as much, drastically less than what it would be a year ago, and people aren't able to go to malls because things are barely starting to reopen and it's a slow pace. But FYI guys, it's not all bad news and gloomy days for Boeing and Simon. We're going to go into both good and bad news that has come out recently, and at the end of the video, we'll make a decision on whether or not these two companies are worth investing in. And on that note guys, I just think it's important to point out, I'm doing these videos for informational purposes, for entertainment purposes. I shouldn't be taken seriously as a financial advisor. If I say I'm investing into a stock, that's my own personal decision, and it's not me necessarily suggesting that you do the same. To start off with Boeing Company, the first bit of news that we're going to look into is the recent statement that the company made announcing that they're going to offer a second round of voluntary layoff packages to their employees. For those of you that don't know, voluntary layoff packages are when employees get offered basically payoff packages to quit their jobs. Now, Boeing had already announced its first round of voluntary layoff packages back in April, and when they had announced back then, they had said that their goal was to cut about 10% of their workforce. They had about 160,000 employees, so that totaled to about 16,000 employees getting cut off from Boeing. Now with this second round of voluntary packages, they're definitely going to be pushing past that. To quote Dave Calhoun, the CEO, "The pandemic has been tough on our people, our business, and our industry. While there have been some signs of recovery, the reality is we are still in a challenging position. This action will extend our overall workforce reductions beyond the initial 10% target and will allow more employees who want to depart the company to do so voluntarily with a pay and benefits package. Importantly, it will also help to limit additional involuntary workforce actions. I truly wish the current market demand could support the size of our workforce. Unfortunately, layoffs are a hard but necessary step to align to our new reality." So not the greatest news to hear from Dave Calhoun, the CEO, but it is an inevitable reality that they're going to have to continue cutting into their workforce just because of the fact that they are not having as much demand. They're seeing a bunch of plane cancellations, and it's still a question mark with regards to how long all this COVID stuff is going to continue for. When we look at this next bit of news, it really does seem to make sense why Boeing is having to make so many cuts to try to adjust to their bottom line. This CNBC article touches base on the fact that for the end of July, Boeing recorded its 6th straight month where cancellations of commercial plane orders have outpaced actual sales of commercial planes. The company reported that it saw 52 plane cancellations in the month of July and only 4 planes actually delivered. Year to date, that makes it 836 plane cancellations and only 74 planes delivered. Boeing is now looking, after all these order cancellations, Boeing is now looking at a backlog of 4,496 planes. That's almost 4,500 planes that they have just sitting with nothing to do. Not good news for the commercial side of Boeing as the backlog continues to grow, as orders seem to continue to come up being canceled. But And this is a very, very good, very shining but. We are seeing the very first signs of life in the opposite direction for 737 orders. As this Reuters article points out, Boeing Company won its first order for its grounded 737 MAX since this year has started. Poland's Enter Air has actually gone into an agreement with Boeing to buy up to 4 of the jets. To quote one of the board members of Enter Air, following the rigorous checks that the 737 MAX is undergoing, I am convinced it will be the best aircraft in the world for many years to come. You guys, this is minor, but great news for Boeing. This is the first order for 737 MAXs that we have seen in 2020. Everything has been cancellations, but this Polish airline has decided to buy not 2, but possibly 4 737 planes from Boeing. Now, does that necessarily mean that we're going to start seeing a lot more commercial airplane orders come in for Boeing in the short term? Not necessarily, and there would definitely be no way for us to be able to tell. But what we can take from this information, guys, is that positive sentiment has not completely gone away from Boeing and their commercial airplanes. Like I mentioned in my video last week, but prior to the terrible crashes that happened with the 737 MAXs, it was a highly favored and cost-effective plane. So, although we can't say for sure, one, as an investor can assume, can hope for the fact that once the revamp starts coming in for air travel and COVID has gone away, you best believe, assuming the 737 MAX has been recertified, there will be airlines lined up ready to stock back up on the plane. But that is not all there is to Boeing, guys. Although the commercial side of their business has been affected very heavily due to COVID, their defense sector has actually been holding up their end of the bargain and keeping things steady while the commercial side recovers. As a matter of fact, the CEO of Boeing's defense wing, Leanne Caret, was recently interviewed, as you guys can see here on this Defense News article. She was asked a lot of questions with regards to how her side of things have been holding up during COVID. To quote Caret herself from this article, she says, "One of the questions that I get a lot is how has that changed, that being COVID, the expectations for me and our defense and space business," Caret told Defense News. And I wanted to just anticipate the question and share that, as I see it, the company's expectations of our business are the same as always. We need to perform consistently and we need to perform well. So it's nice to hear that she's focused on performing with her side of the business, and perform she has indeed. As we can see here by looking at Boeing's investor relations page, she wasted no time on the defense and space sector, getting over 5 contracts with the United States Army, Navy, and Marines, and even some foreign governments to continue supplying military products. One of Boeing's military products that's actually really worth paying attention to right now is the very badass, soon-to-be-released F-15X fighter jet. Actually, Caret was asked about the soon-to-be-released jet during her interview, and she also seemed very optimistic and excited for what's potentially to come with this new fighter jet. The F-15X is actually the updated version of the F-15C, which is a jet that's currently being used by the United States Air Force. Now, as we take a look at the F-15X description on Boeing's website, we come to learn that the United States Air Force has to purchase 72 combat aircrafts every year in order to support the national defense strategy. And what Boeing is doing here on its website is suggesting that the F-15X is the most cost-effective and the obvious choice for the United States Air Force to keep up with this strategy. To read directly off the website, one of the perks the F-15X will provide to customers who are already using the 15C is that it'll require no new logistics chains, training squadrons, infrastructure modifications, program offices, or even weapons integration. So people converting to F-15X can transition within weeks or months, not years, of receiving the new aircrafts. These benefits, combined with the lower cost per flight hour in its class, the lowest cost per flight hour in its class, this makes the F-15X the total lifecycle solution to meet the U.S. Air Force's capacity requirements. So not only is this soon-to-be-released fighter jet a very sleek and powerful-looking machine, but it's also one that's going to provide even more cost efficiency for the United States Air Force, making Boeing a very favorable partner for the United States military. Now, the United States Air Force actually put out a press release on the F-15X fighter jets, stating that they've already given Boeing a nearly $1.2 billion contract for its first lot of 8 F-15X fighter aircrafts. So that means the Air Force is already doing business with Boeing with regards to replacing their F-15C fighter jets with the brand new F-15X fighter jets. As it states in this press release here, 8 F-15X aircraft were approved for the fiscal year 2020 budget, and 12 more were requested for the fiscal year 2021 budget. The Air Force plans to purchase a total of 76 F-15X aircrafts over the 5-year Future Years Defense Program. General Mike Holmes, a commander of Air Combat Command, actually said this: "The F-15X is the most affordable and immediate way to refresh the capacity and update the capabilities provided by our aging F-15CD fleets. The F-15X is ready to fight as soon as it comes off the line." So nothing but good news coming out of Boeing's defense sector with regards to the F-15X, guys. If everything goes well and Boeing's able to keep up their end of the bargain, over the next 3 years, they're looking at a potential $23 billion contract with the United States Air Force. And this wasn't without competition, by the way. Prior to deciding to take on the F-15X fighter jets, the Air Force was actually doing a lot of business with Lockheed Martin and using their F-35A stealth fighter jet. They actually realized a few years back that they needed to cut back on the expenses and that the Lockheed Martin fighter jet was just a bit too expensive and a bit unnecessary, considering the fact that it's a stealth fighter and they don't need a stealth fighter for every mission. So in comes the F-15X as a cost-efficient and more affordable option for the Air Force. So not necessarily taking Lockheed out of the situation, but now Boeing and Lockheed both are in partnership with the Air Force, providing fighter jets for them. As this article mentions, 5 years ago, Boeing's defense sector was actually laughable, and the commercial sector was doing most of the work when it came to bringing in revenue. Leanne Corrett had actually said herself that the defense sector needed some revamping, some revolutionizing, so that they could boost revenue. It's crazy to see now that Boeing is in a position where they're side by side with Lockheed Martin on having contracts with the military. Although this is a great contract that Boeing has before them with the Air Force, the United States military is not the only military group that Boeing can do business with regards to this new jet. It can be in communications, and actually there are rumors of communications with other military groups in different countries as potential customers for the soon-to-be F-15X fighter jet. So with how much promise it's showing here in the United States, one can only imagine how much potential Boeing is going to see with this new fighter jet worldwide. As the defense sector continues to grow, I see ongoing opportunity for Boeing. It can both revamp its commercial sector and come in with this brand new, stronger than ever defense sector that makes it a stronger than ever Boeing. That's going to about wrap it up with regards to news updates with Boeing. As you guys can see, there are both negatives and positives to look at here. On the commercial side, yes, they are very heavily affected by the number of cancellations that they've seen. But as we've seen, they've had that first order for 737 jets already pop up this year, and that gives me hope that we can look forward to a positive time for Boeing's commercial sector a few years down the road. Short term, it is very uncertain what to think about Boeing's stock. What I do believe is that the company is doing what it can to weather the storm that it's currently in, but it's too hard to tell what'll happen with the stock in the short term. I'm optimistic that a few years down the road, once they have their dividend back in play, once they've fully ramped up, I'm looking at a potential double up on my money and a nice dividend payout once the company is back in a stable position. I plan on holding the company pretty mid to long term. Once things ramp up, I'll reevaluate the situation with Boeing and see if it's a company worth holding as sort of a dividend play or something like that. But I'm just looking ahead, guys. Everything is as it goes, and you obviously have to keep up with the companies to make sure that you are constantly updating your perspectives on what the stock could be doing. Going forward, I plan on continuing to invest in the stock. If it stays around my average cost, I plan on putting more until I get about a 3K position in Boeing, as I mentioned in my video last week. If you're someone that holds Boeing currently or that's thinking about holding Boeing stock, leave a comment down below and let me know so that we can get a conversation going about the company. So with all that said, we'll go ahead and move right on to the next stock on today's agenda, which is Simon Property Group. And it's going to be a slightly shorter news update for this stock simply because there's just fewer things to go over. As this article off of CNBC mentions, the company recently reported earnings and announced that their net income had fell to $254.2 million or 83 cents a share in comparison to $495.3 million or $1.60 per share a year ago in the same quarter. Revenue also declined 24% to $1.06 billion when analysts were expecting revenue of $1.14 billion. The mall owner also said that it collected roughly 73% of its rent from retailers in July, with about 91% of its tenants back open for business. It said that it collected about 51% of its contractual rent billed for April and May combined, and then roughly 69% in June. So pretty rough start to April and May, but on the positive side, we see that income from rent is starting to be on a pretty steady incline. The company mentioned having a hard time getting some of its tenants to pay rent at the hardest parts of the COVID crisis. As you guys can see in the article here, it even mentioned that they had to sue Gap for failing to pay more than $65.9 million in rent and other charges. The CEO, David Simon himself, said, "We've still got retailers we need to deal with. Certain tenants haven't paid rent. They have contracts they are obligated to, but certain tenants haven't paid." It may seem like these rent collection rates are pretty bad, but actually analysts were quite surprised with the amount of rent that Simon was able to collect. As it states here, analysts were impressed with rent collection percentages compared with some of Simon's peers in the mall space. Another important thing to know for Simon Property is that as of June 30th, its occupancy rate was at 92.9%, down from 94.4% a year ago. So less than 2% down, which means that although retailers might have been having issues paying rent and things like that, not too many retailers were having to go ahead and straight up leave Simon altogether. All in all, Simon retail properties were closed in the U.S. for about 10,500 shopping days during the fiscal second quarter because of the COVID crisis. A lot of time spent closed in the past quarter for Simon's properties, and that seems to correlate in the drop in revenue. But drop in revenue aside, one of the headlines that's got people really interested in Simon Properties right now is the fact that they're still, amidst all this, making attempts to acquire bankrupt companies. As you guys can see here, David Simon said himself recently on CNBC that the company is still looking to salvage additional distressed retailers, having already made bids for bankrupt Lucky Brand, Brooks Brothers, and JCPenney. To quote Simon, he said, "We're acquiring inventory at or below cost. We continue to look for other opportunities. We are doing our fair share for trying to keep this world as normal as we can." It would make sense for somebody to wonder, with a 24% drop in revenue and almost half of a net income from last year, how it is that Simon Property is able to go about making these bids. And it's because of the cash that they have on their balance sheet. As you guys can see here, this article also mentions that to finish off the quarter, they had $8.5 billion of liquidity, including $3.6 billion of cash and $4.9 billion of available capacity under its revolving credit facilities and a term loan. So although Simon is seeing a drop in its revenue and seeing hard times for its actual retail locations, they are making efforts to continue to acquire locations, especially those that have gone bankrupt recently. And I think that's a smart move for Simon Property, to take advantage of what, like Simon said, cheap inventory in order to continue letting these brands live, but under the Simon name, is a great opportunity for them to bring in more revenue once things revamp and they're able to take advantage of these companies that they now own. Not only can they continue to use these stores and use that cheap inventory that David Simon mentioned, but they can also use these locations for whatever the heck else they might want to get into, which is a perfect segue into the next bit of information that I had on Simon Property, which is a rumor going around that there might be a potential Amazon partnership in the works. Now, Simon Properties hasn't come out and actually confirmed any of this, guys, but as this Wall Street Journal article mentions, Simon has been rumored to be in talks with Amazon.com to convert department stores into warehouse distribution hubs. Whether or not this is a real partnership that's in the works, and whether or not that would be a partnership that's worth it for Simon Properties, is still to be determined. We don't exactly know what that kind of relationship would look like, putting a distribution center in a mall, but to be honest, mall owners across the world are trying to be innovative with the malls of the future. There are articles out there that mention mall owners putting apartment buildings, even grocery stores inside their malls. So an Amazon distribution center inside of a mall doesn't really seem that crazy. But Amazon partnership aside, what I do know is that Simon Property Group is a very well-positioned company with a balance sheet strong enough to help it weather the COVID storm. Not only has Simon showed us that it has the ability to weather this situation, but it's a buyer in this market, which I think is unbelievably amazing. That is why I am going to continue buying Simon Property Group stock. As long as it's around my average cost or lower, I'll continue to put into the stock. But that's my own personal opinion. I'm very bullish on Simon's future, and definitely leave a comment down below if you think the same or have a different opinion. So that's going to wrap it up for my first ever stock update video, guys. Long story short on why I'm finishing it like this, I ended up coming across some technical issues when I was editing. I was using an iPad to edit prior to this video, so I ended up getting a computer now, which was long overdue, and I should be able to get better content out for you guys now. Be sure to be on the lookout for next week's video where I go over some of the things I wish I knew when I got started in the stock market. Thanks again for tuning into Life with Dan, everyone. Have a great rest of your week and take care.